It's not only about history. History can give you an indication, but how are you planning to expand? Which production lines are you planning to look at or invest? Which markets you want to expand into? Is this deal is accretive to your earnings or not? Because you'll go in the guidance in the earning call and you would be questioned about like, did you meet expectation, analyst expectation or not? If you do an accretive deal, that will increase your earnings. So this is another thing that we look at, the projected financial information. Along with the customer contracts, big customer contracts, we typically review that as well.
Welcome to M&A Science, where leading M&A practitioners share lessons learned from their experience. If you're interested in keeping up with the latest from M&A Science, visit mascience.com and subscribe to our free newsletter. Every Monday, we share highlights from our interviews and invitations to events as we build the greatest community of forward-thinking M&A practitioners. Again, that's mascience.com. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Amr Abdelaziz, Senior Director, M&A Finance at Equinix. Equinix is the largest global data center and co-location provider for enterprise network and cloud computing. They trade on NASDAQ under EQIX. Today, we're going to talk about financial diligence and M&A. Amr, how's it going?
All is good. Thanks for having me. Pleasure to be here.
Hey, thanks for coming and take the time to chat with me about financial diligence. Can we kick things off with a little bit about your background?
Yeah, sure. You'll be surprised to know that actually I started my career doing TV commercials. So I've done Coca-Cola. That was my first TV commercial. That was at the time of college. I used my downtime. I've done Coca-Cola, Pepsi, and others, and actually venture out into fashion. I've done 2 seasons for Adidas. And then I graduated from college and my uncle took me aside and told me, you know, this career is a bit risky. It's not sustainable. And my uncle, he owns a CPA firm. So he convinced me to take a CPA and join the Big Four. So, and here it was a leap, change from, you know, doing like a fashion and TV into joining. Actually, I took my CPA, joined the Big Four, joined the PricewaterhouseCoopers in the assurance, in the audit. The first few years was good. I learned the foundation of the accounting, but I felt like I needed something more exciting. So I started to venture out into IPO and capital markets. But I was always, my eyes was like on M&A. Interesting, challenging, you know, with the confidentiality, it's always exciting. And I see, you know, always the M&A folks are in suits. So I was like, you know what? And I hear the announcements, you know, this acquisition has been done. So I was really excited to join the M&A within Equinix, within PwC. And actually, I joined the M&A deals team in the valuation, and then I moved to the due diligence and then corporate finance. With PwC, I've done more than 50 deals on the buy side and on the sell side. So after over a decade with PwC, I felt like I need to get deeper into M&A, like the industry, to get into the industry. And actually I saw like Equinix. And Equinix was like really exciting. They are the world's digital infrastructure. They are the global leader in data centers. And part of Equinix DNA is to do acquisitions. So in the last few years, I've done more than 25 acquisitions and divestitures for more than $15 billion. So Equinix grow through inorganic and organic, but the inorganic piece is part of our DNA. And currently I'm leading M&A Finance.
That's quite the background there. I like how you come from the consulting side, then you wanted to go in-house. And with that experience now, because you've got several years on both sides, what's the big difference?
Between industry and consulting?
Yeah, yeah. You've had like a good portion of both, and I'm just curious because I see a lot of career consulting folks. People that go in house go to consulting, but then having that background and going in house, yeah. How is it different?
Yeah, so for the consulting side, you get to touch on many acquisitions, but you don't get deeper. So initially, it's a good experience to get exposure to the consulting. You just have a project like 1 or 2 months or one deal, and then you jump into the other one. Versus in the industry, you get to see the acquisition from the beginning until the end. Not only that, you get into the details, you get into the decision making. Should we continue this deal or not? In the consulting, you're just helping out. In the industry, you are taking it higher level and decision making with executives. We discuss the deal and what's in it, what's the positive and negative, should we pursue it. We dig deeper into the financial modeling in the negotiation. So in the consulting, I didn't do much negotiation. In the industry, no, we lead the negotiation. It's our company, it's our acquisition, so we have to lead. So it's a kind of a stepping stone. You start with getting the consulting experience, and then you get deeper into the industry.
And you got more on the line.
Yeah.
What's the role of finance in M&A?
Yes, the role of finance is huge. But if we zoom into M&A Finance, which is basically my team, we do pre-sign. We call it. I have two units: pre-sign and post-sign. Pre-sign the deal and post-sign the deal. So the pre-sign, basically, we do financial due diligence. We do the negotiation. We lead the finance negotiation side of the agreement, and the post-sign is managing the sign to close, the condition precedent until we get to close, helping controllership with the opening balance sheet, doing the valuation, the purchase price allocation, and valuing each and every asset we acquired. So the pre-sign is we try as much as we can to unpack the deal before we sign or close. What you don't want to do is to unpack after close, after you close the deal, and then you're surprised with issues, with liabilities. When I was with PwC, there was a client actually had limited access to information. So the diligence were a little bit limited. And after close, they were surprised with a huge tax liability in millions. Another acquisition, machinery, it was a factory, and machinery was taken out from the factory just after sign. So if you have not done your due diligence, you've done the count and understand what's exactly inside the company, then you will be surprised after close. So this is what we do, is try to unpack it as much as we can before we sign or we close the deal, so that we don't get surprised.
Yeah, those don't sound like fun surprises.
Yeah, we see a lot of surprises, but we try as much as we can, as I mentioned, to unpack. But you cannot unpack everything. We try to put protections in the sale and purchase agreement through reps and warranties and others, so that we can try to minimize the risk as much as we can. And this is the role of M&A Finance, is to minimize the risk on the company, especially after close.
You break things down: pre-sign, post-sign. The financial diligence is a big portion of what you do. The valuation falls on your lap as well.
Yeah, so there are two pieces of valuation. The valuation pre-sign, where you are coming up with the value to negotiate with the seller. So this is one piece that as you unpack the diligence or the financial information, you come out with an earnings, a number that is the basis for the valuation. And then we start negotiation on this valuation based on the financial model, on the DCF, and the multiple of earnings. There is another valuation that is at close date, where you do a purchase price allocation. You record your goodwill, you record your intangibles. If you acquired like a trademark, your IP, real property, personal property. So we do after sign, we prep after sign, and we do as part of the accounting standards, we have to value each and every asset we acquired. So there are kind of like, call it a different valuation to determine the price. And there is a valuation that is required from the accounting post or at the time of close. We call it the opening balance sheet.
Yeah, this is where you record goodwill. This is where you value intangibles.
Exactly.
And yeah, okay, so that's all the fun stuff.
Yeah, it is.
I say that I'm sitting in VRC's office because they're nice enough to provide the space, and I'm good friends with their CEO, and it's always like now I start putting the pieces together what they actually do.
Really, that's helpful then.
Yeah, but I could actually learn how it works from you, so that's even better. So we got those views on valuation, sort of get to the purchase price, get to the allocation for the record keeping taxes and those things. What other components, when we think about your role involved with the deal, it sounds like a big bulk of it is diligence, which we want to talk about. But is there any other key things?
No, it started. We typically start call it in the pre-LOI.
Yeah, like can we walk through that? Like, can you walk me through the very beginning, like the timeline of the deal of when you start and what goes on?
Yeah, so typically it starts with our corp dev team, the corporate development team. We have corporate development team in each and every region. So they understand the local market, they scout for deals, and they find like a good deal, and then they call us and say, well, we are the kind of like the SWAT team. They call us in M&A Finance. We need your help to kind of unpack this and see if this is a good deal for us or not. And at this point, we come and start our financial due diligence. We always try to get involved in the deal early in the process. In other companies, you might see finance get involved late in the process, and this creates a lot of issues because you unpack late in the process. It does not give a room to negotiate, or because you're incurring cost. But at the end of the day, if finance got involved late in the process, they might say no to the deal, or they might say that we found that something. So you spend a lot of time negotiating the deal, but you have red flags in the end. So having M&A Finance getting involved early in the process helps the company and helps the corp dev team as well. So as soon as they said, well, come on and unpack, we start leading our financial due diligence. And then we take, the outcome of this financial due diligence to say, well, whether do we need to reduce this valuation or the purchase price? Do we need to patch, the risks through the sale and purchase agreement, or it's no deal? We found like a red flag, and we should not pursue this deal. So this is kind of the pre-sign phase.
I'm trying to get a sense of how deep do you go in that pre-sign phase, and how does it mature in post-sign? Could you maybe get a sense of that as you're still working on the pre-sign diligence?
Yeah, we get really deep. So typically, what happened, we issue a letter of intent or an expression of interest to the target saying, well, we are interested to buy this company with this valuation. If they accept our offer, then what happened is they send us a process letter. This process letter include what are the steps. It's typically prepared by the bankers, and it lays down the steps. When is the next bid is due, the time period, whether it's an exclusivity or not. And then at this time, they provide us access with a virtual data room. This data room includes everything about the deal. Sometimes we found like 50% of what we need, sometimes 30%, sometimes 100%. But we start to look at the first thing is historical financial information, looking at the income statement, and the income statement is US GAAP, it's accounting based. We convert this into what we call quality of earnings. What does it mean, quality of earnings? It means that we transform this income statement into an economic earning or an economic statement where we try to clean it up from any non-recurring events, anything that is one-off, to see what will be the continuing operations when we do the acquisition. Examples of one-off: a fire happened, or one-time revenue related to a specific project that will never happen. We try to clean that up to see what's the normalized revenue, what's the normalized earnings. And based on that, this is the basis core of the purchase price, the valuation.
This is all between IOI and LOI.
The difference between LOI and...
Well, no, like this, all this that you're building right now is happening between IOI and LOI.
No, I would say whether it's LOI or EOI, expression of interest, or maybe we can step back and say, what's the difference?
Just the NDA. Maybe we can step back to an NDA.
Yeah,
then.
Let's step back. So the expression of interest is basically saying, well, we are interested to buy this company. It's typically like a one page and a half. Sometimes we put the value or the offer. Sometimes we don't put the purchase price. And if we put it in range. It's a very high level. And typically we issue it if we don't have much information or we want to leave it up to change. So we don't want to be precise. Letter of intent, on the other hand, is much more detailed. We'll say, this is the price point we're looking, subject to our financial due diligence, and subject to, we'll structure the deal that way, subject to approvals. So it will include much more details. This will be a few pages, 5, sometimes even 10 pages. So letter of intent is much more serious, formal. Expression of interest is just saying, we are interested, but we want more information. Letter of intent is typically you'd get an information memorandum from the seller or some historical information so that you can issue a letter of intent. Expression of interest, sometimes it's based on some verbal discussions. Sometimes you get financials, but expression of interest is, call it less serious. We tend to advise our corp dev team to use more expression of interest because there is no commitment. But on the other hand, they debate and say, well, we have to show serious interest to the target. Otherwise, they will walk away and look for some other bidder. So we always have this interesting discussion, but we agree at the end whether we will use letter of intent or expression of interest.
And then when are you building this internal QofE that you're doing?
Typically, we do after we're done with the financial due diligence. So, and this is the purpose of the financial due diligence, is we're saying, well, this is what the target is saying their earnings. And we do the diligence and we say, well, no, it's actually, their earnings is not $10 million, it's $6 million. And if it's $6 million, you multiply it by a multiplier to get to the value. And then we go through negotiation. The thing is this.
So you're doing this to come up with your purchase price. You're going through the exercise of building this QofE to really be confident in the price you're putting out there. Exactly.
It's a verification is the purchase price is true. That's why in the letter of intent, we say, this is our offer subject to the financial due diligence and subject to that we're looking at the earnings.
Now, you referenced doing this through an auction process. From what I know, bankers usually have a sell side QofE.
Yeah.
So you see that as a standard practice?
Most of the deals now we see sell side. It has been, I would say, in the last few years, I've seen more that the sell side prepare a QofE, because if the sell side prepares the QofE, at least they have done some work. At least they have engaged a big four to do some work. Does this mean that I rely on it? Not necessarily. I have to do my own financial due diligence and come up with my earnings. But it means that they reached out to the target, the advisor, whether it's PwC, KPMG, or others, and have done some prep work. That facilitates our diligence because they have done some work already.
Now you do this. You don't outsource any of it. You're doing this all in-house.
Well, it really depends. We do like many deals at the same time. So it really depends on our capacity. So if we're doing like a $3 billion deal, you need like an army, a big team. So typically we hire like the big four to help us,
Yep.
and we take the output, and we are the one who's negotiating. And back to your question, if you remember, you told me what's the difference between consulting and industry. That's a difference. We take what the consulting does, and we use this input to start negotiation. So we use the quality of earnings of my advisor. I will hire a buy-side advisor like PwC, KPMG, and get the quality of earnings that they prepared, and use this and go and negotiate on the other side with the target. Because we have to reach a middle ground, because we typically, our quality of earnings is different than their quality of earnings. There's no standards around what the amount should be, and that's the tricky and the beauty of it. It's the negotiation art is to negotiate the deal based on this earnings.
Yeah, that's right. My next question I was going to ask, how much discrepancy do you see between the QofE or presented from the sell side versus what you derive?
Well, it really depends on the deals. We have seen, very big differences and small differences as well. But I have never, or maybe rare, that we agree in this is the quality of earnings from your side, and this is my quality of earnings. And typically we agree on a one point in the spectrum, because as I mentioned, there's no standard that says this is the right earnings, because we are looking at the economic earnings. It's not like a US GAAP earnings. And hence we go back and forth in negotiation, and it depends on whether it's a buyer market or a seller market. When it's buyer market, we have the upper hand. We try to push it as much as we can to our quality of earnings, versus if it's a seller market, then they have several bidders. So if they don't like our quality of earnings, they will go to other bidder. So it really depends if you're an up market or a down market. And actually, as part of that financial due diligence, we don't only look at the quality of earnings, because the quality of earnings determine the purchase price. However, we look as well at the quality of assets. What does it mean, quality of assets? We take the balance sheet and say, well, is the AR, accounts receivable, is collectible or not? Because you can acquire accounts receivable, but they will be written off. They're not collectible. You can, there might be off balance sheet commitments, liabilities. So looking at all the liabilities and off balance sheet commitments, sometimes there's a legal lawsuit that they did not record the liability on the balance sheet. So we look at that, and if there is any additional debt or liability, it is deducted from the purchase price. And this can be really material and deduction to the purchase price. So it's not just a matter of earnings, but the deductions as well to the purchase price.
Yeah, that's wait, do you get a lot of that where you find some material change post LOI that has you go back to retrade on the deal?
Yes, we typically, again, it really depends on if it's an up market or a down market. Do I find, the discrepancies? Yes. Typically, you will find, because
So in the up market, it's like, all right, just because of the nature of what it is right now, we take it for stride to what it is, unless it's something super explosive. And if it's a down market, yeah, we can be more particular about it.
Yeah, and we try in Equinix to try to be as disciplined as possible, because in the last 2 or 3 years, the market is an up market. Each and every bid or each and every deal, you find like so many bidders. But we try to have certain parameters in saying, well, if this deal is, for example, is not accretive after close, if 1 and 2 and 3, then we will not pursue unless there is a strategic, specific objective. We want to enter into a specific market that we do not exist, and our customers are asking us to be in this market. As defensive move, we don't want our competitor to own this location because it's a strategic location. So some other, aspects of the deal that you have to look at. It's not only the financial due diligence that you look at, the quality of earnings, but there are other factors that we need to look at it with business. So we sit with corp dev, we sit with the business folks as well to see, okay, this is the finance view on things, but we have to factor in the business view as well.
What about taxes? Where does that fit in all this?
Yeah, so typically there is a team. We have a team that do basically tax due diligence. And the same thing in the Big Four. They have a specific team that does tax structuring and tax due diligence and come up with the issues in terms of any tax issues. And you patch the issues through the purchase agreement, whether through indemnities, whether through escrow. And then typically tax issues are some most of the time are manageable through putting an escrow on the side or having an indemnity or reps and warranties.
Okay, so you got a whole.
But I'm not a tax expert, by the way. We covered only the finance side, but by no means I'm a tax expert. I work very closely with the tax team, not only with the tax team, work closely with the treasury team, with the HR team, legal team, because everything goes back to the financial due diligence. Any liability related to HR, for example, if we're acquiring a company with accrued vacation, with pension, legal, if the legal diligence came up with a lawsuit or something that we need to factor in as a liability on the balance sheet. So each and every other function has to pull down to us to kind of consolidate all the issues and all the deductions to the purchase price and come up with the true purchase price of this company.
We can do a whole podcast about taxes. It sounds like
100%.
The auction process, have you seen that process change over the years? How have you been managing it?
Yeah, so it really differs from deal to deal, but I would say it's not that the auction process has changed. It is the type of market. Is it like an up market or a down market? Who are the bankers? Some bankers will typically deal with the process in a specific process and some others not. But overall, it is, if it's an up market, you will find like a lot of pressure on the bidders. There will be many bidders, and there will be a lot of pressure on the timing. Rather than having 3 months to do the due diligence, it will be just 1 month, maybe 3 weeks to do the due diligence and then submit an offer. Rather than working on an exclusive basis with the target, it will be, you're working against other bidders. So it is whether it's an up market or down market, you'll see the process typically change. In an up market as well, typically bankers will say it's a 2-phase process. What does it mean? The first phase, multiple bidders go against each other, and whoever bids higher after the financial due diligence then be selected for an exclusivity for the second phase. And this is the phase where you negotiate the agreements. If it is in the down market, we see like a one-on-one where it's just one phase. You have time, you discuss with the target the terms, and you know that there is no pressure. You signed exclusivity, so you have much more time to go back and forth. You have the upper hand. You know that this target is not looking around as well, so it gives us much more room. When we work on an up market, it's under pressure, so we are always under stress to complete the diligence as soon as possible, sometimes with limited information. And this increased the risk.
Are you only doing bank deals these days? What about the deals you source?
Yeah, so what happened, we are the global leader in data centers, right? So what happens when we approach a target and they know that Equinix is, interested to buy? What happened? They will hire an advisor, they will hire a banker and say, well, I will invite others as well. I have Equinix is looking.
They always do that every time. They just know that. Hey,
yeah, especially if you're a global leader, this is what we're seeing. So this is unfortunate, but this is the price we typically have to pay as a global leader in data centers. And we have seen it in many deals. We start looking, and then they reach out to a banker and say, well, I want you to run a process.
Isn't
and
that
hence you
Corp
will see
Dev's
multiple
job is to get these CEOs drunk so that, they can build enough trust to get the deal done in one shot?
we haven't tried that, but maybe it's an idea, but not with Equinix.
Yeah, fair enough. Okay, so it sounds like most of the time, even if you start initiating these deal opportunities, it's getting a third party advisor that's gonna keep it pretty competitive to make sure everyone's on their toes.
Yeah, unless you're in the down market. So down market, you have an upper hand, because even if you got like a banker, he might not find other bidders, right? Because it really depends on how solid your balance sheet and the cash available to do the acquisition or the financing. So some other companies might not be as big as us, so they don't have the strong balance sheet to do the acquisition, and hence your bidders are falling apart. So again, it really depends if it's an up market or down market.
Yep, it makes a big difference. What do you want to teach me as a CEO that's going to eventually acquire new business products and lines for our company? Well, teach me some things so I don't screw up financial diligence.
Yeah, if you're a CEO of a company, typically CEOs will be like really, really business oriented, which is typically a good thing. But however, you have to look at other implications, because again, you don't want to do an acquisition and then unpack it afterwards and realize, it's not, I planned, or in my mind, I want to buy this business because it's growing 100% a month over month or a year over year. However, after acquisition, I realize it's growing 25%. So typically, we try as much as we can to inform other teams, and including our exec team and our CEO, about the issues we might find, and that we need time to do a proper due diligence. We need time to unpack everything so that we're not surprised. So, if we're talking about like startups sometimes when they do acquisition, they do small acquisitions. The startup founders are kind of like, they want to do an acquisition as an acquirer, etc., and they don't think about like the financial implications, and they typically get surprised. But as this founder grow into becoming like a CEO of a public company, they realize that you need time, and you need to have a collaboration between different teams, like the HR, legal, corp dev, even risk and compliance, tax, integration team. All of us need to collaborate, and it takes time. It takes time. The deal takes time than anyone expects, because as you unpack, you will find things that you need to make sure that you cover the risk.
Okay, so I'm getting numbers do lie, and to make sure you do your proper diligence.
100%. If there's one advice is number might look pretty, but when you dig deeper, sometimes, or have the time, you might see like adjustments, and sometimes we find issues that even the target did not know about. And this becomes interesting if they are not like financial savvy. They did not know that they have this issue. And when we dig further, this happened with small targets, like if we're acquiring a company 100 million or 200 million. Sometimes they don't have a financial advisors, and hence we find things that are not reconciling, or find an issue that they are not aware about. And we work together to make sure that this issue is, whether we reduce the price or this issue is addressed in the purchase agreement.
Is there anything else that, if I wanted to start looking into details, thinking about either red flags or potential surprises to start with, in terms of like the early things or first things you really want to dig into and doing the diligence?
Yeah, so there are many things. It really depends on the type of transactions. So For example, if you're acquiring a tech company, typically it will start with the technical diligence. If you're doing an acquire, this will be, you'll assess your employees and retention and. So it really depends on the industry and the type of company. So if we're acquiring a software company, is different than acquiring a data center company that is operating. A tech company, you'll start with the tech diligence, and ops team will do their research and making sure this is the right target. And then the financial due diligence might come secondary if it's a pre-revenue startup, or if it's just a small numbers, small revenue. So this is one thing that it really differs from one transaction to the other. If it's an operating data centers, then your starting point would be your historical information. And the second step is looking at the projected financial information, which is an important part. And we typically see the sell side is sending us their projections. Mm-hmm. And you see this hockey stick, as if like, acquisition will happen, everything will be super good, and they will grow like 200% year over year. I would say most of the cases we get this hockey stick in terms of revenue growth from the seller. So we typically prepare our projections. We have a team, a modeling team that prepare our projections. But we reach out to the target to understand their assumptions. Maybe we can use some assumptions that they have used, but we question the assumptions that they have used in the model. So this is a second thing, because you want to project what will happen after your acquisition. It's not only about history. History can give you an indication, but how are you planning to expand? Which production lines are you planning to look at or invest? Which markets you want to expand into? Is this deal accretive to your earnings or not? Because you'll go in the guidance in the earning call, and you would be questioned about, like, did you meet expectation, analyst expectation or not? If you do an accretive deal, that will increase your earnings. So this is another thing that we look at, the projected financial information, along with the customer contracts. Big customer contracts, we typically review that as well.
With the projections, there's the projections the company has. Do you create an interpretation of the projections that you have, or is it just all based off of what they present?
Typically, as I mentioned, is we prepare our financial model and we prepare our projections, because they have typically their projections is like really, really optimistic. If you look at history, they're growing like 5 or 10%, but magic happens after acquisition. They will grow like 50% year over year. And you look at that and say, again, each and every deal, you look at the projections provided by the seller, and you say, well, and when the target sends me conservative, realistic projections, I actually ask, like, what happened here? Is there something wrong? We typically get like very, very optimistic that we typically do not rely on it. We might take some like assumptions, or we might gain an understanding how they build the model, the funnel, the pipeline, the attrition, so that we can embed it in our model. But we have a global modeling team that look at everything and build our model ground up.
The projections, that's the fun, easy part. You just got to make a line that goes up and to the right.
It is the fun, easy part. It is. It has like a piece of an art and a science. Because you can have an optimistic assumption, you can have a conservative assumption. Both are not wrong, right? Because valuation is not like a point. You can say, well, and you have seen like public markets 2 months ago or 3 months ago, when everything was good, they would say, yeah, this is the right valuation because they're growing at X. And then tech now is down 90% or 80%. Some tech companies are down 80%. And they would say it is fair value as well. So it is, valuation is always an art. It's how you justify your assumption is what's important.
What about the relationship component of going through this exercise? Because we've been pretty objective in this conversation about here's the numbers we look at and make sure we check our boxes, cross the I's and T's. What about that? Like, have you ever found that to be an impediment on deals? Just the not being able to create that working relationship with the target company, or is there any factors around that to think about and how well the financial diligence would pan out?
Yeah, that's a good question. So, um, if we found issues, if we can communicate as early as possible with the target and have an open discussion, this is the best course. So, having this line of communication going between the seller and the buyer is key. And there are like different levels of communication. So the CEOs of the two companies typically should not, get involved until, late in the process where everything is done and kind of there are like milestones where they get the view from their teams, but to talk to each other, and this is kind of should be limited. And then other teams like advisors should talk to each other. Our M&A finance team talk to their finance team and try to come up with a resolution. And if we don't come up to the resolution, it kind of like escalates each and every time it escalates, so that we can find a middle ground. And sometimes what we do, which helps in negotiation, is we have an issues list. We tell them that we found this issue, but we put it in the parking lot, and we say, well, we have this issue, and then we park all the issues, and then we have an issue list discussion, and we go through the issues list. And this is typically a very interesting meeting or negotiation where we say, okay, we'll concede on 2 or 3, and you will concede on 2 or 3, because typically there are like a bucket of issues, and depending on the interest from the buyer and the seller and the substance of the issue, you might concede on some and not on the others.
I like where you're going with the issues list here. What are other things that examples of things that you negotiate on?
Yeah, so the number one is, as I mentioned, like the earnings. The earnings is whether it's your quality earnings or my quality earnings, and this includes a lot of adjustments in between. So we go through each one of them. Second, is this a debt or not? Is off-balance sheet commitment should be deducted from the purchase price or not? So we go through the deductions. Third would be kind of anything that we feel like we need much more protection. What does it mean? Things that we are not sure what will happen after close. Call it like taxes. What if there is a tax claim after close? We try to put like an escrow to increase the escrow. What does the escrow mean? It's like carve out, if we are doing an acquisition for 1 billion, we try to carve out, for example, 100 million to be paid after 2 years as a protection for us. So it's held with the bank until everything in relation to taxes. Sometimes it's specific to some items, sometimes it's general escrow. So escrow amount, sometimes it's kind of, we go back and forth whether we want to have to carve out like significant amount. They would say no, it's only 10% or 5% of the deal. Sometimes they say no escrow. So then we look for protection through reps and warranties, or presentation and warranties, to make sure that we are covered. We try as much as we can to increase the reps and warranties so that we are not surprised, because if you have done whatever, like a detailed due diligence, you cannot do like everything. You cannot cover 100% of everything. So reps and warranties, escrow, indemnities will cover any additional risks that we are not aware of.
So that covers the areas where earnings, looking at that first, then the debt deductions, than protection taxes?
Not related only to taxes, any protection. For example, environmental liability. As we acquire data centers, what if there's some environmental liability, something in the ground that will have an impact on the data center? So have we done a complete survey on the ground or not? So we want to have some protection in that regard. So this might be included in the reps and warranties. Reps on the financials, that it's true and accurate. Sometimes we have even specific reps to specific items that we noted in our financial or legal due diligence. Some permits, real estate permits, regulatory approvals, that's not, we sometimes put it in whether it's reps and warranties or conditions to close. You have to take this permit before we close or before we sign the deal.
How, when it comes to working with some of the other components, like how's it working with the legal team? Do you get along with them, or you sort of
Yeah,
gotta go to bat with them a little bit?
Yeah, so typically, I assume you're talking about like the legal team within the company itself, within the buyer.
Yeah, within your organization, what does that relationship look like? And did you interact with them much, or what things would you cover with them?
We interact with them, legal, HR, and corporate development, tax, integration team, risk and compliance. All of the teams we collaborate. We have like a weekly, we call it a deal team meeting, where each and every one of us, we have a representative. We discuss everything in the deal. So we collaborate together. Specifically, we are really close to the legal team and the corp dev team. The legal team is basically, when we do our financial due diligence and we found issues, they are the one who helps us to address and patch any risk in the agreement. So we think together how we can address the risk. I'm not a legal guy, so I need to get their advice. I found this liability, I found this issue, I found this legal or lawsuit that I believe there will be a liability. How can we address it? So the legal team will come up with a good verbiage in the agreement to address this risk. So it's all of us are call it like a one team. We definitely sometimes we debate back and forth. As a finance guy, we always really protective, and we want to make sure that we don't find any surprises. On the business side, they will want to close the transaction. They will want to sign the deal. But we always come to an agreement at the end of the day and say, well, this is good for Equinix, although we know there are 1, 2, and 3, but this can be patched through the agreement or through reduction in the purchase price.
What about we got the big legal part, and it sounds like everything that you find, you've got to work with them to document, make part of the agreement at the end of the day, or figure out how you're going to manage the identified risk. What about HR? What do they do, or how do you work with them?
Yeah, so HR, typically they do their due diligence, and their due diligence is, and I'm not an HR expert, but it really depends on the type of deal. If the deal is we're doing an acquire, we're just acquiring the employees, do we want to retain the employees or not? Is this a carve out of a big company, or is it like 100% acquisition? If it's a carve out, then what are we planning to do? Are we planning to put them in a separate entity? Do we need to hire a CEO for this entity or a lead for this team? So there are a lot of things that HR think about depending on the type of the deal. But from our finance side, we have a line of communication with the HR to understand what will be if there any liability that we should expect after close. Discuss, their pension, understand better if there is a pension plan, stock option plan, anything that will lead to an obligation post-close that we'll have to record on the balance sheet. So accrued vacation, some folks will have a massive accrued vacation or bonus that should be paid by the seller rather than the buyer. We want to make sure that we understand from HR what's the bonus plan and how it is. So we work closely to interpret what they found and see if there is any implication on the liability, because this will be a deduction on the purchase price. So everything is linked back to the purchase price and the agreement.
So you got to work with them. It sounds like you're going to be working with other functions too. Who else do you?
Yeah, we work with the Treasury. Treasury work closely, especially if we're doing an acquisition, for example, in India, or we think through the currency. How are we sourcing the currency? How are we planning to finance the deal? Is this through debt, through equity, through a mix of debt or equity? Do we need to raise capital for that or not? Do we need to prepare a pro forma balance sheet for them to talk to the bankers and get debt financing? They are the one who has the cash to pay. So if we're not working with them closely from the beginning to plan the deal, they would say, well, we don't have cash for you. So definitely the treasury team is really important, and we keep communication. So M&A Finance, call it, we are kind of center. We work with everyone in the organization, trying as much as we can to take all the issues from finance, treasury, and everyone, and try to get the best price for the company for this target, and address the risks in the agreement or through an escrow.
What happens after close? Do you wipe your hands clean and go golfing, or what do you?
I go golfing, that's for sure. But no, actually, as part of the close, the technical accounting team will prepare the opening balance sheet, and part of it, they will ask us, our team, to prepare a valuation for what we acquired. What's the value of intangibles? What is the value of goodwill? What's the value of the trade name, the customer relationship? So our team prepares the valuation or the purchase price allocation that is recorded in the books on day one, and then it will go through an audit from the auditor, and we kind of, if they have any question, we address their questions, and then we go golfing. But rather we go to the next deal, and sometimes we work on like multiple deals in the same time. So it's a kind of a cycle. And what's interesting to me is I get bored easily. So having like one deal, each and every deal is different. And that's what I like about M&A. It's get to see in different countries, different culture, different teams, different operations. And that keeps the adrenaline, that keeps the momentum.
It doesn't get old. I never thought about it from the financial side too. It doesn't get old because there's no two P&Ls are alike. I mean, it's always
And what's interesting in the negotiation, it's you will be surprised, that even my team will ask me, well, why are you passionate about going through this negotiation session? I was like, yeah, this is part of the fun, is to kind of negotiate. There's no right or wrong, but we're trying to reach a middle ground. But it is interesting, it's just how things play in the negotiation meeting and the tactics used. And you'll be surprised of the tactics used and how we put tactics to get to what we want.
Yeah, that's true. That's like the interesting part, because it is, again, varies so much deal to deal. And it's a very unique experience. Where else do you find that?
Exactly, and this is an experience that most probably you will not get in the consulting. It's more in you have to, most probably it's in the industry side.
That's true. It is really different. Just the considerations, because when it's your deal at that point, it's your house. You
have to take the decision.
Yeah, there's definitely.
Sometimes we have the consultant, by the way, in the negotiation room, but they are not the leader, because it's our decision at the end of the day. They will say, well, they will state the facts, but you have to take these facts and their analysis and use it to negotiate. That's
true. It's like truly hard to care as much when it's not. It just is, because I've advised on deals, and as much as you say you do, it's just. Can you teach me a little bit about impairments before we wrap up? My friends at VRC talk about it, but they're smarter for their own good, and I'd rather hear from you.
Yeah.
How does that work?
Yeah. So when you do an acquisition, as I mentioned, you record the assets, right? You do a purchase price allocation. You say, this is the goodwill, this is the intangible. And then the SEC codification or the US GAAP accounting codification will tell you that if you're a publicly listed company, each and every quarter, you have to assess your assets for impairment. So after you do that acquisition, you have to look at your intangible, your goodwill, your real property and personal property, and say, well, do I need to impair any of the assets? And this can be on a two-step process or one-step, doing a qualitative and quantitative analysis. So you start with the qualitative and say, well, is there anything that happened that lead me to believe that I should impair this asset or not? And then you go through this process in the accounting codification until you say, well, this needs to be impaired or not. I'll give you an example. If you have a customer relationship, you recorded $100 million of trade name or a customer relationship, and then something happened in the country that you have done the acquisition where the activity is. For example, a political issue like Ukraine, and then you have to revisit and say, okay, this customer relationship I value based on the growth and based on specific churn rate. However, now there is a war, and now the growth is actually it's decelerating. Do I need to impair this intangible or not? A lawsuit that happened on the trade name. You think about it as, should I discount or impair this trade name value on the balance sheet or not? So you have to ask yourself these questions. What happened to the company itself? What happened to the economy? What happened to the industry? It's more of qualitative, and then you go deeper into quantitative. How about the gross margins? Is this production line is dying? Then we have to think through the factory itself. Do we need the machinery, the economic obsolescence of the machinery if this production line will be liquidated?
Are there incentives for doing impairments where you get some tax benefits out of it? Or I'm just trying to get a sense of what the drivers to get you to slant to impair versus not impair.
Yeah, so it's not a choice. You have to follow the accounting codification, otherwise your financial statements will be materially misstated.
Then what happens? Do I get a slap on the wrist or a punch in the face?
It really depends how material if it is a significant impairment, and you said, well, everything is good, and you did not impair it, you'll get like a material misstatement, and your stock price will go down. So this is definitely not a choice. From a tax perspective, I'll leave it to the tax guys whether there is a tax benefit, but I don't think we should look at it whether it's beneficial or not. It's more of we have to follow the SEC rules regardless. Okay.
Cool. That clarifies that. Yeah. And it sounds like a whole other topic. I could talk more about impairments. So, Amr, I got to ask, what's the craziest thing you've seen in M&A?
I've seen a lot. But if you're asking me the craziest thing, there was a deal that I was working on the buy side. And the sell side, it was a small deal. It was like $100 million or maybe $80 million. And the sell side they were not like financial savvy, and they did not hire a financial advisor. They said, let's save the cost. And from our side, we have the legal advisor, we have everyone looking at the deal. So we put all the protections in the deal to make sure that we are protected. And the debt, we included everything. And then we signed. And we prepared if you remember, we talked about you prepare the purchase price and you do deductions based on the negotiation and the agreement. We have done the deduction, and it came to be a discount of 90% of the purchase price. So if the deal was like 100 million, after you do the deduction, it's like $10 million. Because in the agreement, we were like really broad. We included each and every liability and debt-like item in the agreement. And when we prepared this analysis and showed to the target, they were kind of like, what's that? and they signed the deal. We understand from our side we want to be overly protective, which is typical. And from our side as well, we're kind of like, this does not make sense based on the economics of the deal. At the end, we reached an agreement to come up to a fair price to them against some other concessions from their side. But my point was like, the sell side, you should hire, you should not be, you should not try to save cost and not hire like, a good lawyer or a financial advisor, because the buy side it can happen both ways. But it is critical to get a solid team to help you. You can lose up to 90% of the value of your purchase, what you're getting in terms of cash. And this was kind of a surprise. It was funny to see it. We did not act on it because we were overly protective. But my point here is deals can go wrong on either side.
Yeah.
And I was surprised. I was on the buy side, and I'm kind of the one who negotiated the agreement. But as we kind of unpack, we found like there are lease liabilities and other that needs to be deducted. But that was an interesting one. There is another one that actually between sign to close, we have done everything. I was on the sell side actually, and after we have done everything in the deal, we signed the deal. We had like a mini celebration because we'll get a success fee. I was the investment banker at that time. And between sign to close, the two presidents of the two countries on the media, they didn't get along. And the president put a pause on the deal. The paper of the acquisition went to the president for regulatory approval, and they rejected the deal. So sometimes after you sign the deal, and you see it here in the US a lot in terms of like the antitrust, not the political, but the antitrust, because you have to look at the antitrust, the competition, and make sure you have heard. I assume you heard the like many transactions that broke after being signed.
Yeah. But with the political part, in my head, I'm thinking, all right, somebody's got to get on a plane with a bottle of bourbon and get this thing through. But
yeah, it's unfortunately it's and we were like really, really sad because there is nothing that says that we cannot close the deal, but it is kind of from the president saying any investor from this country is not allowed, and it happened between sign and close. So my point here is external factors have a big impact on M&A, whether from the economy, whether regulatory, war, others that can actually put a pause on the deal. It's not just the hard work of different teams and coming to align with the sell side or the buy side.
This ties back to why you should work with really good advisors as well, because there's a lot of unpredictable
100%.
things that can happen. Amr, thank you so much for taking the time to chat. I learned a lot from this conversation.
Thanks for having me, Kison.
Well, cheers.
I really appreciate and I always listen to your podcast. It's really good.
Oh, that's the best. I don't always get that because it's like I never heard of M&A Science when we reach out. But no, I'm flattered, and this is fun to build a knowledge sharing platform and really define corporate M&A as a career for the industry.
Yeah, you capture like different parts of M&A, whether it's integration and listen to something. It's actually really beneficial for me as well. So it's helpful for the ecosystem of the M&A and our colleagues as well.
Well, thank you, man. I appreciate it. Thank you, Amr.
Yeah.
Thank you for contributing and
Yeah,
making
100%.
M&A Science a little better.
100%.
Cheers, and here's to the deal.
Yeah, thanks, Kison, for having me. I appreciate it.